Good afternoon, everybody. I'm Stacy Scott, and I am the Marketing and Client Relations Coordinator here at Wickham Financial and Insurance Services, and I'm your host for today's webinar. Thank you so much for joining us today. We're really excited about today's session, and we think that you're going to find this topic very interesting. There's been a lot of concern recently, specifically with the regional banks and this credit crisis or crisis of confidence. So Graham is going to take some time today to really elaborate on that. And as always, you're going to see Graham's calendar pop up periodically. And if you would like to schedule some time with him or anyone on our team, just click on the calendar when it pops up and indicate the day and time that work best for you, and we'll get that on the calendar. And also, as a quick reminder, we do have a Q&A session at the end of the presentation. So throughout the presentation, if you have some questions for Graham, just type those into the Q&A section of the chat box, and we'll make sure that he can address those at the end of the session. And with all of that wrapped up, let's turn things over to Graham to get started.
Yeah, thank you, Stacy, and thank you all for being on the call. And I know it's a lot of stress out there and a lot of concern. Is this like 2008 when we're talking about a credit crisis or a crisis of confidence? And we were trying to come up with how we wanted to spend our time, or how we wanted you to spend your time with us on this Lunch and Learn. And we just kept coming back to, you know what, we need to spend some time going over the concerns that are out there, compare, contrast, so we could have a reasonable expectation on what we feel is going to be happening in the market, what could happen in your investment portfolios, the economy, so on and so forth. So let's jump right in. So our title, I think, is pretty right on target. Is this a credit crisis or a crisis of confidence? Because it's different. Both of them are dramatic. Both of them are uncomfortable. Both of them, are going to have the markets go through volatility. And let's just kind of sum up kind of where we're at and what's causing this credit crisis or confidence crisis, if you might. And it's really been spurred on from the Fed. The Fed has engaged in the fastest rate tightening cycle ever in history. Not much more than about a year ago, we had the Fed funds rate at almost about 0%. And then they've launched to 200 miles an hour, right? So if you look at the chart and we go back from the early 80s all the way to 2022, you could see this red line. Wow. I'm going to, just do some drawing here or there and give that a shot today. I mean, look at this number compared to the rest of the period. So we've really caused a lot of stress. And when I say stress, when you're raising rates this quick, this fast, you're going to cause cracks. You're going to keep things, or you're going to allow things to rise to the surface. And I think that's what we're really seeing when we're talking about the regional banks. What money do they set aside to cover for redemptions or loan loss provisions? And yeah, they were investing their bucks conservatively, but when rates rise this quick so fast and they don't adjust the duration of those bonds on the books, then they have less money to cover the redemption, so on and so forth. And that's simply what's going on. Not necessarily is it a credit crisis. It's just what happened with the Fed raising rates so quick, so fast. A lot of these banks have negative numbers on the book to meet the redemptions or the loan loss reserves. So they're going to have to shore those up. So if we think about it in the pace here, look where inflation was when we started the Fed started the whole tightening process or the cycle. Back in March of 2022, we had inflation about 6.7%. But look back at the periods of 2015 to 18 or 04 to 06, 99 to 2000, the mid 90s, in the late 80s. Look at the inflation. The inflation was tremendously less at 0.3 or 2.89%, 1.40. We started at about 6.77%. So we started at a much higher interest rate inflation environment, which means the Fed had to act a lot quicker, a lot faster to bring this down. This high of inflation, I don't need to preach to you about it, is not comfortable. It's not fun. It is affecting the economy. It is affecting the consumer. It is slowing things down. And that's what the Fed needed to have happen. So let's jump right in. Is this 2008? And I think that's kind of where our mind goes, right? So when we're going through these periods of stress, we have some things that seem like something we experienced in the past, like a credit crisis, the global financial crisis that we went in 2008. Our minds go right there and say, okay, this must be the same. I think we're going to challenge that a bit today. It might not be the same, but it certainly has stresses that have to be alleviated. But think about this. Since 2001, we've had over 563 bank failures. That is a lot of bank failures. And I'm not going to make light of it because that's a lot. SVB was not super small, but it wasn't the largest. That was WAMU back in 2008. We had Signature Bank of about 89 million. So, we've had some sizable ones. And the odds are we're probably going to have some more, right? But we got to also realize that this might be a bank issue or one of those regional bank issues. Listen, SVB, Silicon Valley Bank, listen, they were underwater. They were down on the value of their investments to cover those loan losses as well as redemptions on the books because rates increased so quick, so fast, but they could have managed that book a little bit better. Signature Bank, more of a crypto side and the effects of that. So these are, I'm not going to say completely one-offs, but they are unique. And I think we do need to make that clear. They are unique. This isn't a broad-based. This is more regional focused. And we'll highlight that, but a little bit further. But that's a lot of bank failures. So it's not uncommon, uncomfortable, but not uncommon to have these bank failures. So if we look at 2008, stress in the banking system, let's compare that to today. So on this left side, we'll look at the global financial crisis in 2008. We had an oversupply in the housing sector, right? We had a mass amount of homes, completely different than what we have now. We got an undersupply of homes, right? And high interest rates. We had poor underwriting standards. Anyone that wanted a loan could get a loan. Really, the ones who got the loan probably shouldn't have gotten the loans, right? We had tremendous over leverage and interconnectedness in the system. And what we mean by that is the system was so tied into each other, it was like a dominoes. When one fell, the other fell, so on and so forth. So what we're seeing today with the regional banks and the Fed stepping in, the Treasury stepping in, is they're trying to stop a systemic risk in the regional bank system that might flow into some other sides. But today, we still have some issues. We have high quality bond portfolios. Those are high quality bond portfolios that are at the regional banks and other banking institutions, but they've lost value, right? Because of those rates increasing so much. We've had depositors can move their cash quicker than ever before. They're on their phone. They're hitting their app, and they can move it over to JP Morgan or Bank of America or to any other institution, Schwab, at a push of a button. Well, we didn't quite have that flexibility back then, right? So is it a run on the bank? Is it a credit crisis? I think it's a crisis of confidence, and you had a good old-fashioned run on the bank helped with technology and social media, right? Doesn't mean there's not cracks. Doesn't mean there's probably not a fire where there's smoke, but it doesn't mean it's systemic and it's going to spread across the whole banking industry. We just don't see that, but we do see concerns. A threat of impaired profitability for smaller banks. Well, if they got to shore up those balance sheets, right, they're going to make less profits and revenues. Their lending standards are going to increase to shore up those books, to protect their books a bit more, which means profits and revenues are probably going to have to be addressed. And that's not just with the smaller banks. That's going to be with larger, all financial institutions to some degree. If we look at the households and corporate balance sheets, they were also really weak. If we look at the mortgage debt, this is staggering to even think about. It was 65% of the gross domestic product of the United States. Now, much more manageable today, it's 45%. 45% in a healthier consumer, in a healthier economy, healthier banks, so on and so forth. So quite a bit different. We also have the consumer and corporate debt service ratios are at secular lows, but that still didn't take the pain away from the banks, right? So we kind of look at year-to-date performance. If we look at the S&P index, the NASDAQ, which is tech-laden, the Dow, which is the Dow 30, and we look at large banks, the large money centers, let's say like JP Morgan, Goldman Sachs, Bank of America, Citigroup, so on and so forth. We're seeing them down, 10 odd percent. But we're seeing the regional banks down roughly 27 odd percent. But we've really seen a flight to a quasi bank. I would almost say a flight to these large cap technology stocks because they feel like they don't need to go out and get a loan to fund any merger or acquisition or to grow because they have a lot of cash already on the balance sheets, like Microsoft and Apple, so on and so forth, just to name a few. I'm not saying it's 100% correct, but that's why you're seeing what's going on. You're seeing it leave the stress area that's going to continue to be stressed if we go into a recession, moving over to the tech stocks that have a lot of cash on the balance sheets that don't need the loans. So that's why you're really seeing that shift in that market. If we think about 2008, we're really, it's probably not the same thing. And I say this, probably not. We just don't think it's the same. Now, it's got some rhythm to it. There certainly are issues, but it is a completely different environment. So right now we're looking at stronger corporate balance sheets. Listen, they're coming down. When interest rates are moving up this quick, so fast, you're seeing these high growth, cool product, cool service that got us through the pandemic. Those companies are being hit because they have earnings in the future. Maybe they have to get loans to fund their growth today, and that's a lot more costly. And that side of the market's really struggling right now. But we still have strong corporate balance sheets, even though I made that last statement. They're reasonably strong, even though they might get in a little more weak with those rising rates. We have increased banking oversight compared to 2008. That's night and day. We have increased loan loss reserves, so the banks have kept more cash on the balance sheets for potential losses, as we've had plenty of time here to prepare for what if. What if we go to a recession? What if earnings are dropping? What if losses, we have increased losses from loans because we're in a recession, so on and so forth. So the banks have had time, not to mention time from 2008, but time over this last year and year and a half to really kind of prepare and get themselves ready for what may be coming. We have a much healthier consumer than we've had before. They have a strong savings rate right now. They have less debt on the balance sheet. They're less over leveraged than they were in the past. If we go into a light recession or recession, we got to expect everything to come down. Corporate earnings will come down. Consumer demand will come down. With just the fear of losing a job or ability to pay for certain items. So, we do think things are healthy, but they could, relax a bit. And we're in a relatively strong economy. Listen, we left the fourth quarter. I think the gross domestic product was revised as a positive 2.4%. Now, that's in the past. I think there's some projections out there looking at about 2.5. Now, that was before the whole regional bank issues over the last couple of weeks. So that might be coming down a bit, but we're not necessarily in a recession right now. It doesn't mean we're not going to, but technically we're not in a recession. Now, if you've been on other calls, you're a client of ours, you know that, hey, we probably do have rolling recessions. So we might have certain sectors, say the housing market, so on and so forth, that might have their own recession going on. But from the broader U.S. economy, we're just simply not in a recession yet. And I say yet because when we get to that slides, recessions are normal, not comfortable. I'm not trying to make light of them, but they are normal. They're a part of how the markets function. So if we think about the banks, what liquidity do they have right now? Well, the Fed's opened up their discount window. What that means is that is an availability for banks to go in and get cash as needed to shore up their balance sheets. We've also seen the Fed and the Treasury also do what's called mark to basically not mark to market, they're marking to par. So if some banks out there have debt on their balance sheets and they're owning the government-backed debt, which is the safest debt, so they're doing basically the correct things, and let's say they're underwater right now, and that bond's going to mature in 2 years. What we're seeing is the government or the powers that be is stepping up and saying, hey, listen, we're going to mark that to par or at maturity, which means we're going to show or allow you to show that value as if it was already matured. Because the government's going to pay that debt back anyways. They're just shoring it up today, saying not marked to market, not marked at current value, which is down. Hope that makes sense for everyone. I know sometimes that can be a little confusing, but that's been a big benefit to kind of short these balance sheets. Also, it hasn't hurt to see bond yields. Really, yields pulling back a little bit. When yields pull back, what happens? Bond prices go up. So we want to think about the traditional relationship between interest rates and bonds, right? So think about a seesaw on a playground, right? On one side, let's say this right side over here is interest rates. This side over here is principal values. When interest rates move up, principal values in the older bonds go down. Why? Because newer bonds are being issued at higher interest rates, right? So people are going to sell the older bonds to take advantage of the higher interest rate bonds that are out there. So that's what we're seeing. So as the yields have pulled down, not to mention the yields moving up so quick, so fast with the Fed, that brought bonds down. Recently, we saw yields really moderating quite a bit. That's helped out these books of the banks. If we look at the mortgage debt percentage, so let's look at the the Bear Stearns collapse. We're talking right around 2008 when all that was going on. Look at that. We had a mass amount, and look at this run. We had a mass amount of debt that was on the balance sheets, but look at where we're now. Quite a bit less. Doesn't mean there's not a fair amount, 45% compared to the GDP, but that's quite a bit different than 60 plus. All right. Now let's think about investment performance and Fed tightening. All right. So let's look at it this way. Do the markets always have to go down when the Fed tightens? What are the market's performance as we're in a tightening cycle or when we end a tightening cycle? What sides of the market perform better, if we're towards the end? So let's take a look at that. So equities by size and style. So if we're looking at equity size and the style performance of 1 year following the Fed's first rate hike. So the first rate hike was March of last year. So 1 year following the Fed's first rate hike, look at this. S&P was up 6.24%. If we look at the Russell 1000 value side, it was up 3.91. Russell 1000 gross was up 3.58%, but the Russell 2000 was up 11.30, probably some of the growthier side. Think about also this, the Russell 2000, let's say the small cap index, I think about 25% of that index is made up of small financials, regional type banks. So you're seeing right now, that side of the market or that indices being hit much harder than, say, the S&P, because the S&P is up, 3 or 4% year to date. The NASDAQ's up, in the teens, because you're seeing that side of an indices being affected the most because that's where it has more exposure to those regional banks and those small financials that we're so concerned about. But look at this performance in the market after 1 year from first rate hike, right? If we go a little bit further and let's look at fixed income, all right? So we looked at stocks. Now let's look at fixed income bonds. So you have your U.S. aggregate bond index. We're still looking at the performance 1 year following the Fed's first rate hike. Listen, we had bonds up across the board, right? But I would add some more flavor to this. Think about this. We had the worst bond contraction ever in history last year, right? So if this is true and it wasn't the worst bond contraction ever in history, because we had the Fed raise rates the quickest, the fastest, these numbers could be higher. I'm not going to say a guarantee, but they could be higher than what we're looking at from the median standpoint, from the mean standpoint. So the U.S. aggregate bond index up 3.43. Investment grade bonds, 3.93, but high yield, that riskier side, like the Russell 2000, up almost 5%. So again, if we were kind of had more pressure this time and the rates went up quicker than ever in history, we could actually see bonds up even a lot more than the mean returns that we're looking at right here. Here, let's just, we'll kind of wrap it up. The 1 year following the Fed's rate hike returns across all risk asset classes. But look at this. We saw the Russell Value 1000 up the most, up 11.82%, followed by the Russell 2000, 11.3%. And then we saw the S&P 500. The reason why I keep bringing that up, because that's generally the overall market that most of us are following. You know, that was up about 6.24 in the U.S. aggregate bonds of about 3.43. So 1 year after, we're still seeing the markets up. Let's talk recessions. You know, that's the big concern. Has the Fed raised rates so quick, so fast that they're going to push us into a recession? As the rates increase so quick, so fast, and it's causing pain, it's causing stress, it's causing cracks and failures in the regional and the financials, is that going to cause a recession? And the odds are yes. Does it have to be deep and protracted? I know that's not what anyone wanted to hear, is going to be deep and protracted. No, we don't think so. So we say take 2008 out of your mind, but it's still some stress that has to be dealt with. So here on this graph, we're going back from 1970, and we're looking at each one of these periods where the Fed has raised interest rates. See these big spikes. So I'm going to kind of highlight these big spike periods, like here, here, right here. All right. And then the question mark is here. So let's look at these. So we've had a large spike in the 70s, and then we followed into a recession. Large spike in interest rates, we followed into a recession. Spike in interest rates, even though we didn't have a recession here. And recessions are marked with the gray lines, right, that we're seeing. And then we've had a recession for the most part, not every time, but might be a light recession, might be a deep recession, following dramatic rate tightening by the Fed. Now, what's the odds that we'll see it again? The odds are high that we might get into a light recession, but it doesn't mean it has to be a deep protracted. And think about it this way. By the time that you get confirmation from the government posting the gross domestic product numbers that says that we are in a recession, listen, folks, we're probably already basing out and coming out of the other side. So whatever you're thinking about doing to protect yourself from a recession, by the time you get the economic numbers, it's probably already too late. So the odds are, sure, it didn't help to have the regional banks failures that we've had and the crisis of confidence in that area. They're going to have to tighten their lending standards, which is going to be more stress on the system, and some other areas that I'll touch on here. That, yeah, the odds are probably increasing that we could see a light recession from our standpoint. But I don't know if that's anything different than what we said. We said last year was not a recessionary period. We said we don't necessarily have to have a recession, but the odds are increasing that we could, but it could be light. So what do recessions mean for stocks? So stocks don't always decline in recessions. Look at this. I mean, look at these periods. I mean, it's almost 50-50 if you go back from the 50s recessions to 80 recessions to the 70s. On average, during recessions, we're looking at the S&P was down 1.53%. We got 4 different periods in there where we're in a recession, during a recession, and the market's up 18%, 16%, 7%. So, I mean, not every time do we have to all of a sudden have these big market drops. So not necessarily hand in hand, and maybe for many of us, probably a surprise that it wasn't as bad as you thought. Let's go one step further. Let's look at stock performance at the end of and following recessions, all right? So we see the time frames here on the left side, and now we're looking at 3 months out, 1 year out, 3 years, and 5 years out. Look, 3 months out, the S&P index is up almost 13%. 1 year, 15%. 3 years, 40%, 5 years, 78%. So after the recessionary periods, we're still seeing reasonably strong performance in the market. So what's next? I'd love to tell you that the possibility of additional bank failures aren't there, but I think they are. Where there's smoke, there's probably fire. We do think it's probably been largely contained, but there's still cracks that still need to be filled, and some banks will probably still fail. We probably have too many regional banks out there. So, but we've seen this is not necessarily comfortable, but not necessarily a surprise since 2001 with 500 plus bank failures, right? We do think it could be a sideways market. We started out the year pretty strong. Tech really rallied the most. We thought you might get a reversion to the mean. What sold off the most in 22 might rally the most in the first part of the year. We saw that. We've seen that in technology. Is that going to hold up and be as strong going forward? We'll see. But the stuff that held up the best last year is probably the stuff that's underperforming. Healthcare, utilities, the more defensive areas. Do we think that's going to continue to underperform? I don't know about that. I think you're probably going to have some sort of equilibrium here. You'll have a balancing effect. And again, we do think we're probably going to see potentially a light recession. But again, recessions happen all the time. If you've been on any one of our webinars, we spent a lengthy amount of time talking about recessions and how they're not uncommon. They're just not fun to go through, right? Inflation down, but still elevated. Listen, the Fed has a mandate of getting inflation down to 2%. I applaud that. I think it's too ambitious. And I think we just have to maybe expect inflation being elevated for longer, for a longer period of time. Challenges in the commercial real estate market. I think the regional banks, the commercial real estate market, regional banks fund about 70% of commercial real estate debt. We can't do away with regional banks. We got to find a way to solve this, firm them up, let the healthy survive, the ones who aren't merge in, because we need to protect the commercial real estate market. Not just because of the regional banks upping their credit standards and restricting some additional loans to the commercial real estate market. We've also seen a whole shift in the work environment, right? Don't forget about the hybrid workspace. So a lot of businesses had large office buildings and a lot of square footage for staff that are now working from home in other locations. So they don't need that large footprint anymore. So that's putting added pressure on the commercial real estate. But we do see that's probably a challenge right now, probably nothing that you haven't really heard of to this point. And it all caused by the tightening credit standards that we have going on. So what do we do? What are considerations? Take advantage of the fixed income opportunities that are out there. Your short-term money, your ultra-safe money, stuff you need for a project, 6 months to 1 year. Take advantage of these CD rates, the 3 months, the 6 months, treasuries. Take advantage of the money market accounts and money fund accounts that are getting 4.5%. You can do it. You don't have to put all your money at the risk in the stock market. You have options. If you have any expectation of times better in the future and the Fed lowering rates, or at least now plateauing to potentially start to lower, you can start to go out on your fixed income, your bonds a little bit and not stay short. So you can get a little more yield and plan a little bit more of a capital appreciation down the road. Good old-fashioned diversification has never gone wrong. Always own quality in environments like this. Not the time to gamble. Make sure they have solid earnings, 1 and 2 in their sector, great cash flows, great management, and I love catalysts with dividends. You meet those qualifications, there's going to be something that could be considered. And just take the overall long-term approach. Sometimes when you're in the middle of the battle, I've thrown out my little analogy, it's hard to see the direction of the war. And I know it's uncomfortable. I know we want this thing over with. We just need a little more time. So keep, thinking out there a little bit. Things will get better. The market's already bouncing a little bit. It's going to have its ebb and flow here. So don't just think everything's fine just because the market's up a little bit. We still got to get through some rough patches. Keep that long-term approach. Keep some money in those fixed income areas. A little more cash. You're getting paid to do it. Stay diversified and own quality. That's simply the best advice I can always give. Stacy, you want to turn it over to some questions?
Absolutely. Graham, the first question that we've had come in is, do you think the Federal Reserve will continue to increase rates?
I hope not. I think it's going to depend on how quick, how fast inflation is going to be coming down. Um, we do feel the recent regional bank crisis that we're going through, and crisis of confidence, right? Not just financial crisis, crisis of confidence.
Right.
We think it's doing some of the job of the Fed. So we think it's time for the Fed to step off the gas pedal. Let's wait and see. Let's see what's going on. They just got done raising 25 basis points. They've already hinted and said, listen, they're going to be vigilant, but they've acknowledged that the recent regional bank issues and commercial real estate issues will do some of the job for them. So we think they're going to pause here. We think there'll be a wait and see. We think inflation's coming down, which is good across the board.
Okay.
Yeah.
Are we planning to have a deep, protracted recession?
Boy, I think I said that multiple times in there. No,
Yeah.
right? No, we just don't. I'm not going to say we couldn't be wrong. Of course, there's no crystal ball here, but no, we just don't. We think with strong balance sheets for companies, shoring up the banking system, since we went through such a dramatic period in 2008, you got a different banking environment, under leveraged consumers, all in a reasonably strong economy, not just in the United States, but internationally. We think that's a recipe for a light recession, if a recession at all.
Okay. All right. And is the investment market overpriced?
Depends on how you look at it, right? So let's think about this. What do we have? About a P on the S&P of about 18%, 18 times forward earnings. Arguably, if we're going into a slower period, 18 is a pretty reasonably high multiple. So could this market drift back down to 15 and 16, even lower if we get a deep protracted recession? Absolutely. Are we inexpensive? I don't think that we're inexpensive. I don't think we're dramatically overpriced. You still might see some of the tech area averaging a PE multiple of about 27 times. They traditionally have a little bit higher multiple anyways. It's come down from last year, but still high, right? Especially since they've had outperformance this year. You're looking at the rest of the market somewhere around 15, 16%. So not inexpensive, but not dramatically overpriced.
All right. Well, thank you so much, Graham. This information that you've shared today has really shed some light on some of the concerns that I'm sure a lot of us are sharing right now. And thank you to our viewers for joining us today and for getting those questions in. Just a reminder that you can always keep up with the current market events by watching our weekly wrap up every Monday. And that's available to you on social media and also our website. So be sure to check that out. And just want to thank you again for joining us today. And we hope you all have a great afternoon and a great week. And we'll see you on Monday for the weekly wrap up. Thanks so much.
Take care.